The Mercer Ledger, July 7th, 2026. Why a temporary oil flush is the higher probability scenario right now. Saudi Arabia just executed its largest official selling price cut in at least 26 years. Court OPEC Plus simultaneously raised output quotas by another 188,000 barrels per day for August. West Texas Intermediate sits near multi-month lows around $68. This is not random. It is defensive floor holding as Hormuz traffic normalizes and physical barrels return faster than demand can absorb. Markets interpret aggressive discounting and higher quotas as confirmation of oversupply, exactly the narrative that triggers momentum-driven downside. A historical read, 2014-2016 Saudi-led market share defense amid rising supply produced a grinding collapse. Early 2020, supply response to weak demand delivered a sharp flush. Current setup aligns more with 2014 mechanics than a sudden demand shock. Prices are already discounted. The signaling effect raises the probability of a temporary but violent leg lower, likely in the $8 to $15 range in West Texas Intermediate, before any new equilibrium in the next 2 to 6 weeks. Why not immediate stabilization then up? The producer moves are pro-cyclical in the short term. Algorithms and speculative flows reward the clear glut signal. Saudi wants revenue long term, but the intermediate action creates the window for overshoot. Stabilization becomes more likely after flush clears weak hands or geopolitics tightens. Key watch points over the next 7 to 14 days. West Texas Intermediate Brent momentum acceleration, Gulf tanker flow data, speculative positioning reports, any softening or follow-up on Saudi OPEC rhetoric. The lag door on freight and upstream costs remains open regardless. A flush does not invalidate the broader compression. It accelerates the behavioral shift when shelf prices reflect it. This is probabilistic, not certain, but the data and precedent tilt heavily toward the temporary crash path first.